Good afternoon, class. My name is Tom Hickey, and I'll be your instructor for Introduction to Grain Trading and Risk Management in the Commodities Markets. I've been a grain merchandiser for a little over 20 years, and in today's discussion, we're going to explore how the futures market and futures contracts are used within the grain industry to mitigate risk, and how basis is used to establish both cash market prices and generate profits. The topics that we will be going over today will be: what are the futures markets? What is a futures contract? What is basis? What is meant by being long or short? And what is hedging? The futures markets are a financial exchange where futures contracts are traded on various commodities. The purpose of the exchange is to act as a clearinghouse on all of the daily contracts that are traded, to assist in price discovery of the futures themselves, and to provide standardization on the futures contracts. A futures contract is an obligation to buy or sell a commodity at a certain price on a certain date at some point in the future, hence the term futures contract. Some examples of commonly traded commodities can be agricultural products, such as corn, soybeans, wheat, or rice, precious metals, such as gold, silver, or copper, energies, like oil, gasoline, natural gas, or ethanol, and currencies, such as the US dollar, Canadian dollar, or the Australian dollar. Commodity futures were traded in an open outcry system until several years ago. Advancements in technology have allowed the majority of trading activity to now be done electronically. Commodity futures trade in specified increments for specified time frames. For example, corn trades in 5,000 bushel increments. One futures contract of corn is equal to 5,000 bushels. The commodities also trade against specific futures months. In our example of corn trades against the March, the May, the July, the September, and the December futures months. So if it's January and I want to buy or sell a futures contract of corn, I would be doing that against the March futures if I was looking to buy or sell that corn for January, February, or March. If it's January and I would like to buy or sell a corn futures contract for October or November, I would do that against the December futures contract. With futures, you're either long or short the underlying futures month. When I go long futures, that means I've bought the contract. When I go short futures, I've sold it. So just to give a quick example, if I have a point of view on corn that the price of corn is going to go higher, I can go out and I can buy as many contracts of corn as I want. Let's say I buy 5. I go out and I buy 5 March corn 24 contracts. At some point in the future, I will need to offset that position. The way I offset it is to do an opposite bid equal. So if I have bought 5 March 24 corn contracts, at some point I will need to sell 5 March 24 corn contracts. The difference between the price I bought it at and the price I sold it at will determine as to whether or not I made a profit or a loss. This also works in terms of selling the contract first. If I want to go and short corn because my point of view says that corn's going lower, I can go out and sell 5 March corn 24 contracts. And then in order to close out that position, at some point, I will have to go in and buy 5 March 24 corn contracts. The difference between where I sold them versus where I bought them back will determine whether or not I made a profit or a loss. This is a snapshot of the corn futures market. And what I would like to do here is focus on row 2. And you can see the ticker symbol says CH24. So that was going to be March corn of 24, which it says in the description to the right. As we keep going to the right, under the last column, we have 446.6. That's the price of corn, the current price of corn, the last trade that happened. Corn trades in quarter cent increments. So 2 represents a quarter, 4 represents a half, 6 represents 3 quarters. So according to this, the last trade on corn was $4.46 3/4 per bushel. If we keep going to the right, we have the change. If it's green, it's up. If it's red, it's down. Since it's green, we know that corn is currently up 1.25 cents. The bid and the ask represent where people are willing to buy and sell corn. The bid is someone wanting to buy. The ask is someone willing to sell. So someone's bidding that they will buy corn, they'll go long corn at 4.46 3/4. Someone else is saying they're willing to sell corn at $4.47. We know from the last trade that the 4.46 3/4 traded. There was a buyer and a seller at 4.46 3/4. As we keep going to the right, we also have the high and the low market price for the day, and the settle is the closing price of yesterday's close. So now that we've talked about futures markets and futures contracts, who is it that is participating in the futures markets? Well, there's really two main groups. You have hedgers. Hedgers can be producers, the farmers who produce the crops, and end users, such as grain elevators, processing plants, and feed mills. These individuals either have or want to have physical ownership of the commodity, and they're going to use the futures markets to manage price risk. The other group in the market are speculators. Speculators are not interested in having physical ownership of the commodity. They're going to do what we call trade paper. They're going to go in and buy and sell futures contracts without ever wanting to own a single kernel of corn or of whatever commodity they're trading. They provide liquidity to the markets. They're going to use the futures markets to assume risk through trade positions. Hedgers want to offset or mitigate risk. Speculators want to assume risk. Speculators can be individuals, like in the example I just gave where I had a point of view on corn. But by and large, when we think of speculators or talk about speculators, we're really talking about the funds. Companies like Goldman Sachs or BlackRock who manage trillions of dollars, a piece of that money they invest in the commodities markets. As a matter of fact, I believe in the last Commitment of Traders report that I looked at, the funds were short 275,000 contracts of corn. And remember that each contract of corn is 5,000 bushel. So they were short about 1 billion bushels of corn. So now that we've looked at futures markets and futures contracts, now we're going to talk about basis. Basis is the futures price plus the basis equals the cash price. Basis is used by end users. It's used by your grain cooperatives, your processing plants, your feed mills. Speculators don't care about the basis. It doesn't affect them. They're strictly trading the futures markets. End users are going to use the basis to establish the cash price of grain into their facility for a given time period. You can think of basis as a lever that end users pull to either speed up or slow down the amount of grain coming into their facility. When we talk basis, we could say that the basis is under, which means negative. So you're going to subtract the basis from the futures price. Or we can say that the basis is over, which means it's positive. That means you're going to add it to the futures price. Or we can say that we are bidding option. Remember, bid is willing to buy. So if I'm bidding option, I'm willing to buy corn at option, which means I'm bidding a zero basis. So I'm basically matching the same price that's on the futures board. When basis becomes more negative, we say it's widening. If, given our example of corn being at 4.46 3/4, if I'm a 10 under basis, I'm bidding the farmer 4.36 3/4. If I have a lot of corn coming at me and I go from 10 under to 15 under, I've went more negative. So that basis is widening. On the other hand, if I'm bidding 10 under and I go to a 5 under, that basis is narrowing. It's becoming more positive. So when we talk about basis, one thing that really confuses people is, well, how is the basis set? So on the futures market, the future price is set through price discovery by the exchange. But as you get out into the country, how is basis set? Where does it come from? Well, basis can be affected by or is determined by a lot of things such as local, national, and global supply and demand, the needs of the facility, and competition in the area. The map on the right here, each dot represents an ethanol facility. So this map does not include grain cooperatives, and it doesn't include feed mills. All of these dots are just strictly ethanol plants. Each of these plants is looking to buy a certain amount of corn into their facility. I have Chicago listed in red. It's kind of hard to see, but if you know where Chicago is, you can see it. So the futures market, the Chicago Mercantile Exchange, is in Chicago. But for a plant in Iowa, Minnesota, California, Texas, that futures price doesn't necessarily make sense for their market based on where they could either resell the corn at or sell the products they have or that they make from the corn. So each location will set its own basis. Now, locations that are close to each other could have a similar basis. It doesn't have to be the same. It really depends on the needs of the facility. So let's take all this and put it together. Futures and basis, futures contracts, how does it work for an end user? So we have Farmer Joe. Farmer Joe would like to sell 20,000 bushels of his corn for February delivery to his local grain elevator, Local Grain Inc. Local Grain Inc. is bidding 15 under the March. It's a negative basis, so it's under. 15 under the March for corn delivered in February. And we said the current price of the futures is $4.46 3/4. What cash price could Farmer Joe receive for that corn? Well, since it's an under basis, we know we're going to take the futures price plus the negative basis, and that's going to give us our cash price. So in this case, we would be bidding, willing to buy $4.31 3/4 per bushel. Farmer Joe looks back at the basis history of our facility and realizes that 15 under is historically narrow and decides to sell. So when he looks at the basis history, he if he's been keeping track of it, he can go back and say, well, normally in January, they're bidding between 20 and 25 under, and now they're 15. They need corn. This is a good basis. So I'm going to go ahead and take advantage of that and sell it. So now Local Grain Inc. has bought corn for future delivery. It's January. They bought the corn for February. How are they able, what risks do they have, and how are they able to manage it? Well, Local Grain Inc. has price risk. They have bought 20,000 bushels of corn at $4.31 3/4 for Feb delivery. And they don't know what the price of corn is going to be in February. They don't even really know what the price of corn is going to be tomorrow. Nobody does. So how are they going to manage this? How are they going to mitigate the risk? They're going to hedge it. Local Grain Inc. will hedge the bushels they bought in order to protect themselves from price movement. Since they bought 20,000 bushels, they are long cash or long corn, right? They have bought it, so they're long. To hedge this, they're going to need to go out and short futures, right? They're going to do the opposite. This isn't going to close the position. This is going to hedge the position. So they'll go out and they will short futures by selling 4 March 24 corn contracts. But how does this protect Local Grain Inc.? Well, let's look at how market movement will impact our risk management strategy of hedging. Let's say the futures markets go higher. So now it's February, the corn is being delivered. The futures price is now $4.96 3/4, and Local Grain is 30 under the March for a cash price of $4.66 3/4. Local Grain has a cash gain of 35 cents per bushel. Remember, they bought the corn at $4.31 3/4. Now they're paying $4.66 3/4. They bought that corn cheaper than what they're paying today. But they also went out and shorted the market at $4.46 3/4. And now the market is at $4.96 3/4, which means they have a 50-cent loss per bushel. But the end result of this is that they still own the corn at a 15 under the March. And at this point, you're going to say, well, why would they do that? Because if they hadn't hedged it and the price went higher, they could have made more money. They bought the corn cheaper than they could buy it today. Well, the reason you hedge it is because, again, we don't know what the futures are going to do. And let's see what would happen if the markets were to go lower. So in our next case scenario, the future markets are lower. And in February, when the corn is delivered, the futures price is $4 3/4. And Local Grain Inc. is at option, right? They're matching the futures board. So they're paying a cash price of $4.75. So now Local Grain Inc. has a cash loss of 31 cents. They had bought that corn at $4.3175. They can buy it today at $4.75. So they've got a 31-cent loss in the cash. But now they have a futures gain because they shorted the futures. They shorted it at $4.4675, and now the board's at $4.75. So they have a 46 cents per bushel gain. The end result of this is they still own that corn at 15 under the March. But what is the big deal about making sure that we lock that basis in, that we own that basis where we originally bought it, no matter what the markets do? The reason that we want to do this is because we're basis traders. Once the grain is hedged, Local Grain Inc. will make money from this grain by trading the basis. What does that mean? With ownership at 15 under, no matter what the futures markets do, Local Grain Inc. will look to sell this corn at some point in the future at a basis that is narrower than 15 under. This is where they're going to make their margin. So let's take a quick look at one possible sales opportunity. A few weeks after purchasing the corn, Local Grain Inc. sees that the local ethanol plant is bidding 20 over the March for March delivery. By selling the 20,000 bushels to the plant, does Local Grain make a profit? If yes, how much? Local Grain will earn a profit. They own the corn at 15 under, and they're going to sell it for 20 over. That's 35 cents per bushel profit before expenses. Their expenses would be transportation. They're going to have to load it on a truck and truck it to the ethanol plant. Their elevation cost, in about 1 month of storing that grain in their facility. This is how end users such as processing plants, grain co-ops, feed mills, this is where they make their money, is by trading basis. You buy the grain, you hedge it using the markets, you lock in the basis, and then you look to sell it at a better basis in the future. In summary, the futures markets provide standardization, price discovery, and act as a clearinghouse for commodities. Speculators are not interested in physical ownership of commodities, but they do provide liquidity to the markets by just trading paper. End users use the futures markets to hedge and mitigate price risk. Basis is used to establish cash market prices throughout the country, and trading basis is how end users earn margin. This has been Risk Management and Trading Commodities. My name is Tom Hickey, and thank you for attending.